You look at what has happened in the world since March 2020, the vaccine rollouts, your liberties, the stock market performance around the world, global markets, and the United States is a top 10% performer.
I received a question from Jason on Instagram, and here it is. Hey, wife and I have about $150,000 in cash sitting in the bank. We want to jump into some real estate with rentals or Airbnbs, but the market right now makes that not ideal. We want to find something to do with that money with a time horizon of 1 to 2 years just to keep inflation from eating away at it. What do you recommend? Thanks, Jason. Jason, thank you for connecting on Instagram. If you guys want to connect with me on Instagram, I'm at Marriage, Kids, and Money. You can connect with me there. Jason, congratulations on accumulating such a gigantic chunk of change in your savings. That is very cool. Now, options abound, of course, but real estate has proven to be an excellent place to invest your money. But where should you start, right? You got rentals on your mind. You got Airbnbs on your mind. Well, I thought I'd answer this one with my friend Sam Dogen again. Sam, also known as the Financial Samurai, retired from his corporate career about 10 years ago. Real estate, among many other avenues, was a huge part of his financial independence success. Outside of achieving FI in his 30s, Sam is also the author of the new book, Buy This, Not That: How to Spend Your Way to Wealth and Freedom, which is out now. Welcome back to the show, Sam.
Thanks for having me, Andy.
Absolutely, man. Good to have you back. We've had you on for a few episodes, and they've all been wildly successful, so I'm glad to have you back here to help out Jason. Let's answer his question. He's got $150,000 sitting around in a bank account right now. What options does Jason have to invest in real estate in this tough market?
Well, so first of all, I think we need to put $150,000 in context. Is that all your net worth, or is it 10%, 20%, 50%, 70%? So if we assume with $150,000 that it's less than 20% of one's net worth, we got to go from there, right?
I think that's a good assumption, yeah.
Let's think about the real estate market now. Mortgage rates have come up about a couple percent over the past 6 months since the beginning of the year. Corporate earnings are slowing. The Fed has signaled that they want to raise rates for another 12 months. Who knows whether they will or not, because the market has sold off and it's doing a lot of its slowing for the Fed. So if you think about real estate in previous cycles, we've had a great bull run since 2012. The real estate market really started taking off since 2012, and it's had a 10-year amazing run. And that run has accelerated since 2020 because the value of property has gone up, because most of us are appreciating our homes more because we're staying at home more, right? The angle of that curve upward has steepened. Now, given we're going into a rate hike cycle, and if you look at previous real estate cycles, you could easily see the real estate market go down 5, 10 plus percent over the next 1 to 3 years. So if you're thinking about mobilizing your cash because you're afraid of losing purchasing power to inflation, that's the wrong way to think about it. I would much rather lose my purchasing power to inflation than actually buy real estate and have it go down 5, 10 plus percent. I mean, that's real losses. Whereas losing money to inflation, even though they talk about real inflation rate and all that, that's not real. It's just purchasing power. So I would say you should take your time over the next 12 to 24 months. There's no rush to jump into real estate right now, because these real estate cycles really take a long time. Think about it as a super tanker that takes a while to turn versus a speedboat like stocks that go up and then they just crash the next day down 30 to 50%. So first of all, I would just take your time and not be in a rush, and to think about the returns a little differently. There's nothing wrong with holding cash now, especially as rates are going up. In fact, the more cash you have, I think right now, the better you're going to feel, and the more you're going to outperform the average person.
Yeah, I think maybe if he asked his question a little differently, as opposed to, hey, for the next 1 to 2 years, I'm looking to throw in some money in real estate. If he said, hey, as a long-term investor, I'm considering getting into Airbnbs, rentals, whatever, other real estate option, would your answer be different?
Yeah, I mean, sure. It depends on your time horizon, right? If you're looking at it for income right now, leveraging up to buy real estate now with rates higher and the market slowing, I think is a suboptimal decision. Instead, I would not be taking leverage. Again, it depends on his current existing net worth. Does he have a primary residence already? Does he already have multiple rental properties? Does he have debt? And if he's just, let's say he has his primary residence, I would be looking to be more real estate light. So instead of taking on leverage to buy physical property now, especially in cities such as maybe Austin, Phoenix, Memphis, where supply is increasing And when before the pandemic, one of the big fears about heartland real estate was endless supply because of endless land. I would be more real estate light, where I'd be investing in REITs or big real estate index funds, or maybe private real estate where you can invest $10, $100 a month. Be more real estate light, because the timing right now to get into debt at this point, I think, is a mistake. You want to be waiting with a lot of that cash, that $150,000 cash, $1,000 cash, for value, for vulture opportunities, which will inevitably come. You just have to be patient.
I like that. Yeah. So, I mean, thinking about this maybe in the past where somebody feel bad having that much in cash because they're not, I guess, taking advantage of the market, whether it's real estate or stocks. This is a time where having some money sitting in cash might not be a bad idea. And actually, you're seeing some companies talk about, this as an opportunity for them to maybe take advantage of sales that might be coming down the road. Would you agree?
The slowdown is here, and it's going to be more and more apparent when the data comes out. The data is lagging indicator, but it's really clear. If you see stocks down 20%, you see tech stocks down 30 to 80%, giving back 2 to 5 years worth of gains while still having the same headcount, inevitably there's going to be a reduction in headcount. It's an inevitability, folks. So you really got to change your mindset from how do I make the most amount of money possible to how do I protect my capital gains. So if you have $150,000 in cash, I would hug that cash and really be patient for opportunity, because they always come. Now, who knows how bad things will get? I mean, maybe we've already hit the bottom with the 20% down in the S&P 500 to 3,800. It's a reasonable valuation level. It kind of goes back to historical median valuations. But the last asset class standing is real estate. Think about it. Stocks are down, bonds down, crypto down, art, real estate, doing well, outperforming. It's not like it's going to, I don't think it's going to crash, but you could easily see 5-10% down and a lot more inventory coming up. So be patient.
Well, if they have that patience and maybe a long-term outlook, you talked a little bit about real estate light. Talk to us about the difference of, maybe going and getting a big bank loan to buy your own Airbnb or rental property versus something like REITs or these other online platforms. And I know you've dabbled in that quite a bit. So talk to us about those advantages.
I mean, I just spent before this podcast about an hour painting a second coat on my rental property door. And then I put the curtains up, and I'm building a deck. I mean, it takes a lot of time. And so that's not light, that's heavy. That's not passive, 100% passive, that's semi-passive, right? And so as a father of two who's 45 years old, I don't want to spend all that time. I want to spend more time with my children, writing and doing what I want. So when I talk real estate light, I talk about public and private, listed or unlisted real estate assets, right? So REITs, public REITs or private REITs, private funds. I have about 10% of my real estate investments in private real estate funds. And one of the reasons why I did that was because I wanted to take advantage of the heartland real estate, because I have most of my real estate in San Francisco, Honolulu, and Lake Tahoe, which is much more expensive. So I wanted to diversify. But second, I also didn't want to see what the daily movement was of my real estate properties, right? It kind of stresses me out. It's not fun when you see your stocks go down 20%. So I wanted it to be an asset allocation play that's 100% passive, that's out of sight, out of mind, and to think about more like capital allocation for the long term. So that's what you have to do. You've got to look at your real estate portfolio and your time and your interest and decide what percentage of your real estate allocation wants to go to physical real estate and real estate light investments.
I like that. Do you have any platforms that you enjoy more than others, or ones that people should stay away from? I know you've investigated this a lot as part of your research on your blog.
Yeah, I mean, I like Fundrise because they started in 2012 when the Jobs Act was passed. So it's one of the oldest real estate crowdfunding platforms. They're vertically integrated, so they decide to handle the sourcing of funds, the analysis of deals, and then the rehabilitation of properties. And it's a fund where I don't have personally that much time to pick individual deals and then build my own select real estate portfolio. It's just kind of like picking stocks. Hopefully, like other platforms, they do screen other sponsors and other deals. So they try to choose the best out of the best. And then it's up to you to choose the best out of the best that fits your criteria on their platform. However, I like Fundrise because of the asset allocation into single family homes in the Sun Belt. I think that is a long-term trend that is going to continue thanks to work from home and technology. And the cap rates are higher, so net rental yields are higher. Valuations are generally lower than coastal city. However, now you're seeing much more parity in terms of value, a little bit more parity in terms of valuations, right? Because places like Austin and I don't know, Miami or something, they've gone up 40, 50%, Phoenix, right? Whereas San Francisco, Manhattan, maybe we're only up like 20%, right? I think real estate investors should think about that I don't think anybody talks about is that the pandemic has throttled foreign investor demand of US real estate for the past 2.25 years. And before the pandemic, you saw over $100 billion of foreign real estate demand come into the United States. And the Asian money would come to the West Coast, European, Russian money would come to the East Coast. And a lot of that has been throttled. So I think when the pandemic finally ends, or just, I mean, we're getting on with it right now, but when borders open up again, I mean, China's still going through lockdowns and everything. You know, if you're a wealthy person out there, you want to diversify out of China, because even if you're a billionaire in China and you're locked down, that sucks, right? And so I think within the next 12 months, you're going to see over $200 billion of pent up foreign real estate demand of US assets that first attack the coasts and then slowly move inland.
I guess that slowing has to do with a lot of our deteriorating relationships, US wise, from China, as well as what's going on in Russia as well.
I think that's only a part of it, but you just have to put yourselves in the shoes of a upper middle class or wealthy Chinese or Russian individual. You look at what has happened in the world since March 2020, the vaccine rollouts, your liberties, the stock market performance around the world, global markets. And the United States is a top 10% performer, right? Our stock market has outperformed like 90% of the other world stock markets. We've got quicker vaccine rollouts. We have more freedoms. We have less corruption. Although inflation is above 8%, it's still lower than many other countries. So we've outperformed. So any intelligent person in a foreign country will be thinking, well, you know what? If they outperformed during one of the worst times in history, I want to try to allocate some capital to America. And one of the easiest ways to do that is not only to get an education in America and work in America, but to buy real assets in America. And that's through real estate.
Got it. Well, I love this conversation about real estate. I hope it's helped Jason out a lot. So, Sam, you've got a new book out there, Buy This, Not That. That's a very catchy headline, especially when we talk about personal finance with shopping habits. I know you've got a spin in there. Tell us what Buy This, Not That means.
Well, every choice is a choice not to choose something else. And so the whole idea is that money is finite and time is finite. So my hope is through Buy This, Not That, to help people make more optimal decisions through a lot of life's biggest dilemmas. And I really want to teach people to think in probabilities, not absolutes. So a lot of times people think in absolutes, which means 100% certainty that this is the right choice. And if you wait until there's 100% certainty, you're probably going to miss out on a lot of amazing opportunities. You know, I'm not going to ask this girl out or this boy out until I'm absolutely certain they like me back, or else I'm going to feel like a fool, right? Then you never ask the person out. And then 10 years later, you run into them on the street and they say, hey, Jack, hey, Mary, how's it going? You know what? I got to say, I really had a crush on you back in the 8th grade, but I was just too afraid to say. And then she would say, oh, I had a crush on you too. Why didn't you speak up? You know, and then that's like opportunity lost. And so if you think in probabilities, I think there's more opportunities. And I have a 70-30 decision-making framework where it basically states, if you believe there's a 70% probability or higher that you're going to make the right decision through your analysis, through your experience and so forth, you go ahead and make it with the humility, knowing that 30% of the time you're going to be wrong, but that's okay. And you're going to learn from your mistakes and make better decisions going forward. So the book, it's not only a book about achieving more wealth, more freedom sooner, it's also about using your money to tackle some of the big dilemmas. And some of the big dilemmas include, should I marry for money? Or should I marry for love? Should I send my kids to public school or private school? Should I help my adult children with a down payment on their house and car? Or should I just let them, fend for themselves? And so it's just a lot of these dilemmas that I think about, that I've been through on my 45 years here. And I think a lot of other parents will go through as well.
Absolutely. We got a lot of parents looking to build wealth and happiness on this show. Sam, thank you so much for diving in to Jason's question today, telling us about your new book. If people are looking to connect with you outside of the book, where should they go?
Oh, they should just go to financialsamurai.com. And if you want to check out the book, it's financialsamurai.com/BTNT for Buy This, Not That.
Excellent. Excellent. Sam, thank you so much for your time today, and I appreciate you connecting again. Thanks, man.
All right. Thanks a lot, Andy.